Hey everyone, so welcome back to the channel. Now with the tax filing season upon us, I thought for this week what I would do is do a compilation video of all the tax tips I could ever think about. So hopefully it could help you save some tax or make your tax filing process a lot smoother. Now because this video has over 60 tax tips, I have broken them down into different timelines for different categories. So check the timestamp to find the categories that apply to you. I will also be making them into different shorts and upload them on YouTube and also Instagram. So if you want, you can also check out there for a more concise version of different categories. And before we jump into it, as always, make sure you help us like this video and also join our private Facebook group where we have over 5,000 members in there. You can ask different questions and also get different resources as well. Alright, so let's jump into today's tax tips and we're going to start with the RRSP side. Now my first tip is very easy. It's going to be that RRSP contribution deadline is March 1st of this year. So if you still want to buy some RRSP to offset your tax of previous years, make sure you do so in the next couple days. Now my next tip is for RRSP matching program. For the employer side, understand that they will overall not help you save any taxes. While their RRSP matching help you reduce tax, you get the exact same amount as taxable benefit on the other side, which will neutralize each other and giving you no tax saving at the end. Only your portion of the matching program will actually help you save tax. Keep that in mind because a lot of people actually get confused when they receive their tax bill thinking they get a much bigger tax refund than they actually do. Also, know that your RRSP deduction can be carried forward for later years. Just because you bought RRSP now doesn't mean you have to use it right away. If you foresee a higher tax bracket coming in the future and you want to save it for later time, you can do so. But by buying it early, it gives you a quicker access to tax shelter growth earlier. So you can always buy a bigger chunk first and then save the rest for later time. Next is to talk about spousal RRSP. If you and your spouse have different tax bracket, the higher bracket person should consider getting a spousal RRSP instead of just a regular RRSP. That way you can push any future retirement income to a lower bracket spouse, which in theory should have a lower tax rate by the time you retire as well, helping you spread out your retirement income that way. Now this also brings me to my next tip, which is the exception of when you do not want to do so. It is when the lower income spouse has a good defined benefit plan, which means they would likely to have a very decent retirement income. If that's the case, maybe the higher bracket spouse should not do a spousal RRSP. Speak to your financial planner or CPA before moving forward. And for RRSP home buyer plan, know that if you have taken out money to buy your first home, starting the second year of doing so, you have to start paying back 1/15 of the amount every year. If you do not do so, that amount will get added onto your income for the year and you will have to pay tax on it. You can repay by simply buying the same amount of RRSP and indicate on your tax filing that you're using it to repay your home buyer plan and not using it as a new write-off. And for my last tip, it will be to take advantage of the RRSP matching program in your company. Sometimes I hear people say that they do not want to opt into it because they want more freedom and they want to do their own RRSP. While that will give you more freedom, having a 1-to-1 or even 1-to-0.5 match is much better than just doing it outside because that is essentially free money. So if your company offers it, you should definitely take advantage of it. Now moving on, let's talk about tax tips for donations. My first tip is to know that donation credit get a much better calculation once you're over $200 for the year. And also know that every year if you claim donation credit, that $200 calculation restarts itself. Which brings me to my next tip. If you do not want to use it for this year because you don't have over $200, donation credit can be carried forward for a maximum of 5 years. Also, you can combine donation credits with a spouse, so you can push all the donation onto one person, so only subject to $200 threshold one time. Now, as for how much maximum donation you can claim per year, you can only claim up to 75% of your net income. Unless for that year, it is your final year before you pass, or you have donated ecological preserved land. If either of those is true, then you can claim up to 100% of your net income for that year. For high income earners, know that if you make over $200,000 per year, your donation credit calculation gets an even better calculation. Instead of the usual 29% tax rate for federal level, you now get to write off at a 33% level. So if you make more money, especially over $200,000, you should definitely consider donating more. Now for donation, know that you do need an official donation tax receipt in order for you to claim donation credit. So before you donate, make sure the charity you donate to can and will issue you a donation receipt. For personal donations on GoFundMe, you do not get to write them off because they are counted as gifts, not donations. However, charitable fundraisings on GoFundMe will count as donation. And also, generally, if you want to count as donation credit, usually you should only donate to charities within Canada. However, there are exceptions to some charities that are outside of Canada and will count as well. If you want to find out more, check CRA website or consult with a CPA. And if you want to donate public stocks or shares to a charity, it is much better for you to donate in kind directly to a charity. That way you do not trigger capital gain tax, but you get the full donation credit at the same time. This is much more tax efficient than selling the stocks and donating the cash. Alright, so that's all the donation tips. Next, let's move on to medical expenses. For medical expense, first thing to note is the 3% rule. All the medical expense you spent cannot be directly written off. Only the amount over 3% of your net income can be written off up to a maximum level per year. However, medical expense does not need to be a calendar year. It can be any 12 months rolling forward. What that means is you can pick your highest medical expense month and start there and move 12 months forward in order to give you the maximum write-off and only subject to the 3% rule once. As for family medical expense, you can actually lump all the expense into one family member. This will allow you to maximize your write-off, and also typically you want to push it all to the lower income person because they have a lower 3% threshold. However, there is an exception when you do not want to do that. It is when the lower income person has already enough tax credit to bring their tax bill to zero. Any more medical expense claim under that person would go to waste. And lastly, my tip is that many items can actually count as a medical expense. CRA website has a very extensive list and they include things even like IVF. So if you're not sure, check the CRA website or check with CPA before you decide if you want to claim as medical expense. Alright, next let's talk about childcare related tips. My first tip is that childcare deduction has to be claimed on the lower income spouse. So if you have one spouse that is not making any money at all for that year, those deductions may actually go to waste. In order for a person to count as eligible children, they have to be under age 16 and be dependent on you, unless they're mentally or physically disabled. Plus, their income for the year should be under the federal basic income level, which is $14,000 for 2022. Eligible childcare expense are anything that you would have to pay in order to take care of the children, which allows you to go outside and earn income, run a business, go to school for 3 consecutive weeks, or do any research where grants have been given to you. Now, there are different childcare expense for different age and status of the children, as you can see on the chart. If you have more than one children, all the limit add together for the total write-off that you can claim per year. Also, for maximum claim, it cannot be over 2/3 of your earned income per year. However, if you have incurred over that, you may be able to get some tax credit via different programs out there. If that is the case, consult a CPA before claiming your child expenses. Now, for childcare expense, know that any cost paid to a relative that's over 18 to take care of your children count as eligible expense as well. So if you want to, you can pay grandma to take care of her grandkids and it will count as well. Know that grandma on the other side will have to report that earned income. Now, even though a lot of things can be claimed as childcare expense, here are the following things that you cannot claim. Number 1 are medical hospital care, transportation cost, or clothing cost. Number 2 are any fees paid for educational purpose, for example, tuition paid for a course or fees paid for a training program. Lastly, any fees that are paid for leisure programs, for example, a tennis lesson or registration fee for scouts, cannot be claimed as childcare expense. If your kid has tuition credit, you can actually transfer up to $5,000 per year onto your tax income so you can get some tax saving up front. If you are 19 or older or you have a kid that is so, you should encourage them to file their tax even if they have no earned income. The reason why is because they may get some tax credit, for example, GST or HST, or CWB for low income family, which is basically free money from the government. Now, for child support, if you're paying them, know that you cannot deduct tax on it, whereas spousal support, you can reduce tax. If you lower your net income, you can also bump up your childcare benefit. So things like RRSP is especially important if you have a kid, because on one side it gives you more tax refund, but on the other side it brings down your net income, which gives you a higher benefit as well. For tuition credit, the amount of tax saving you get is on a pre-calculated formula. It has nothing to do with your net income. So there is no advantage by saving your tuition for later time. As soon as you get them, you should be using them to get tax savings up front. You can claim up to $250 in training credit every year for a maximum of $5,000 in your lifetime if you're between age 26 to 66 and you have spent money for eligible courses or training programs. If you're not sure, check the CRA website or check with CPA to find out if you are eligible to claim this credit. Finally, for government student loan programs, know that the interest you pay can provide tax saving for you. So if you have multiple loans you're trying to pay off, a government student loan is likely going to be the least prioritized loan that you should be working on. Alright, so next let's move on to investment related tips. Alright, so my first tip is investment carrying charges. Know that any interest you pay on an investment loan for the purpose of potentially generating income in a non-registered account can be written off of your income. Now the key word here is potential to generate income, so even buying stocks that have never paid dividend count as well because they do have the potential to pay dividend in the future. This brings me to my next tip, where if you use a line of credit as a down payment to pay for your pre-sale that is not built yet, the interest you have paid during those times is not tax deductible because the building is not built yet, so there's no potential to generate rental income. Also, you cannot write off any loan you have used inside an RRSP or TFSA account or any registered account because they are tax sheltered investment already. So this is why if you're going to borrow money to invest, you should borrow and invest them in the non-registered holdings. My next tip is going to be superficial losses. If you have sold securities in a non-registered account and bought identical or very similar ones that is close to identical within 30 days, your capital loss that you would claim on tax filing may be disallowed by the CRA. So if you're not sure, consult with a CPA before doing so. Next is to remember to report tax on the spousal loan interest generated. Higher income spouse can invest in a lower income spouse non-registered account through spousal loan agreement. However, the higher income spouse must pay the interest stated in the loan agreement by January 30th of every year and also report that earned interest income on the tax filing. If you fail to do so, CRA will disallow the spousal loan arrangement and you will face income attribution. Next, you also want to pay attention to the types of investment income you receive. Generally, capital gain and dividends have a much better tax rate than interest income. So when it comes to tax filing, if all you've been reporting is interest income and no cap gain or no dividend, then maybe it's time for you to take a look at your portfolio and see if you need to rearrange anything. However, your risk tolerance should always come first and it has to make sense before you consider any tax distributions. For capital losses, know that you can carry backward 3 years to write off previous capital gain taxes or be carried forward indefinitely. Capital loss can only be written off against capital gain, not your regular income or rental income, so keep that in mind. Investment vehicles like TFSA, RRSP, even the new FHSA or any other registered account are typically much better tax-wise versus a non-registered account. So those accounts should be considered to be maximized first before you start investing in a non-registered holding. If you have over $100,000 in cost for any foreign investment outside of Canada, you do have to report them with a CRA. This includes stocks that are listed only in the US stock exchange. However, if you get exposure to these investments in an ETF or mutual funds based in Canada, you do not count towards that $100K cost. Please also keep in mind that this is about declaration. As long as you make any investment return, foreign or local, you do have to file them with CRA. Alright, so with that done, let's then talk about real estate related tips. First tip is about moving expense. If last year you have moved 40 kilometers or more closer to your school or work, you can claim moving expense on your tax filing. For first-time home buyer, you get to claim the first-time home buying tax credit. Usually it is $5,000 before, but for last year they have doubled it to $10,000, which will give you roughly $1,500 in tax savings. As for first-time home buyer plan in RRSP, remember you can take up to $35,000 as a down payment for your first home. However, over the next 15 years, you do have to repay that amount slowly by buying RRSP back in. If you do not do so, 1/15 of that amount will get added to the income for that year and you have to pay tax on it. If you have bought a new home or substantially renovated and paid GST or HST on it, know that you may be able to qualify for the new housing rebate. Now, as for people with disability, if either you or your spouse meets the CRA requirement for disability, then you may be able to claim the first-time home buyer tax credit even though it is not your first time buying such home. Also, if you meet one of the 3 requirements listed on CRA website, you may be able to qualify for the home accessibility tax credit, which can help you save tax on eligible renovation costs of up to $10,000. If you can claim the accessibility tax credit we just mentioned, you may also be able to claim 25% of your renovation costs as medical expense for tax credit. Now, for rental properties, on top of claiming the usual expenses, you can also claim depreciation on the building of your rental property for extra tax saving. However, if you do claim depreciation, know that by the time you sell your property, there's likelihood where you have to repay some of it back, known as CCA recapture. And if you have worked from home as an employee, know that you can claim up to $500 under the flat rate method, or you can claim more potentially using the detail method. So if you're someone that are renting properties and working from home, you should definitely consider the detail method, which is likely going to give you more tax write-off. When claiming housing expense for self-employed or commission people, you should consider using the number of room as a calculation as opposed to the square footage percentage. This usually will net you a lot more write-off when it comes to claiming expenses. And if you have renovated your house, know that not all renovating costs can be written off for that year. If the renovation is done to extend the shelf life of your rental property, you cannot write that off that year, but instead the cost gets added to your ACB and will help you reduce capital gain tax when it's time to sell your property. For example, replacing one broken window can likely count as cost for that year, but replacing all the window in the house is likely going to be added to ACB instead. If you're not sure, check with your CPA before claiming those expenses. If you flip pre-sale assignments, know that 100% of the profit you make is counted as business income and is taxed, as opposed as counting as capital gain, whereas 50% is taxed only. And if you previously own a home but now is moving out and renting it to someone else, you should definitely hire an appraiser to get the fair market value on the date that you move out. This can help calculate your capital gain tax when it's time to sell that property, which is likely going to be a lot less than what you expected. And if you're moving out and renting it to someone else, as long as for the next 4 years you do not own another home that you live in, you can apply for something called Section 45-2, change of use with CRA, to extend your principal home exemption for 4 extra years on that home. So when you sell it, you can reduce capital gain tax significantly. Alright, so finally let's talk about self-employed tax saving tips. First one is car expense. Other than gas and insurance that you usually pay, know that all other maintenance costs, even lease and financing costs, can be written off as well. For home office expense, you can claim rent or mortgage interest for the part of the home that you use as an office. And also you can claim any internet, utilities, or cost for furniture that you have spent for your office space. When claiming housing expense for self-employed or commission people, you should consider using the number of room as a calculation as opposed to the square footage percentage. This usually will net you a lot more write-off when it comes to claiming expenses. However, for meals, you cannot claim your own portion of the meal as write-off. So likely you will have to take your meal bill, divide it by 2 and only claim half of this. And within your meal bill, also know that you cannot claim alcohol tips in there as well. And if you're self-employed or doing a business for yourself, know that once you make over $30,000 in revenue for a single year, you do have to register for a GST or HST number. However, there are other jobs such as financial services that are exempt from GST registration. Check with a CPA if you're not sure. But if you do register for a GST or HST number, know that any GST, HST that you spend on any expenses related to your business, you can recover those amounts. Next, if you are paying your spouse for some work, know that you need to show a clear track record of the work they have done in a market hourly rate that is justifiable, or else CRA will have issue and treat this as income splitting. Finally, if you're self-employed and you start having surpluses of business after all expense and taxes, maybe it's time for you to consider incorporating. By incorporating, you will only need to pay 10 to 12% of corporate tax on any amount left inside your corporation, which is a lot more tax efficient, and those surpluses can now be reinvested within your corporation. Alright, so that's all the tips I can come over for this year. Do you think they're helpful? Have any of them helped you when it comes to tax saving or tax filing? Let me know in the comment down below. And also, if you have other tips you think I have missed or I should include in my next year's video, let me know in the comment down below as well. If you like these kind of videos, I do upload them 8:30 EST every 2 weeks. That is the schedule I'm trying to keep before my baby comes out. So make sure you subscribe to the channel, click the bell button to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you in the next video. Bye!